I appreciate all of you being here today. Just a quick show of hands. I hadn't realized I was in an exchange-traded fund track, which is fine if that's what everyone's here for, all ETFs all the time. No? Yeah, that's my presentation. The question is, do you want it to be all about ETFs, or are you okay with it being a little broader? Okay, good. I'm a generalist. My husband always says I'm kind of a classic Jeopardy player. I know about 2 things about everything. So it should work well if you're looking for sort of a broad-ranging discussion of where Morningstar thinks the market is at currently. So this presentation, I sometimes joke, is my red meat presentation because it attempts to surface a lot of investment ideas, whether you're a stock investor or a fund investor or an exchange-traded fund investor. My goal here is to give you some food for thought as you think about positioning your portfolio. Just a quick overview of Morningstar. Quick show of hands. How many people are familiar with Morningstar and the stuff we do? Okay, good. Most people. I remember when I started at Morningstar, my mom was like, veggie burgers, right? And so there are some people who don't know what Morningstar is, and the way that I always shorthand it really quickly for people who aren't familiar with what we do, especially for individual investors, is that I think of us as kind of the Consumer Reports of the investment industry. That we don't have a vested interest in whether you do your business with Fidelity or Vanguard or Schwab. Our goal is to provide research and help you draw your own conclusions about the best investment products for you. We built our brand as fund researchers. When I started at Morningstar in 1993, that was really our bread and butter. We were doing an annual source book at that time and had Morningstar mutual funds. But since then, we've evolved in a few different directions. We built out our equity research group, so we now have more equity researchers than most mutual fund companies. We also have a growing team focused on exchange-traded funds, because we've seen very strong uptake of assets in exchange-traded funds. So those are our main research areas at this point. We also have a lot of asset allocation and portfolio planning knowledge that we acquired when we purchased Ibbotson Associates about a decade ago. And Roger Ibbotson was one of the leaders in terms of talking about asset allocation, the portfolios split between stocks and bonds and cash, and how influential it is in ultimately shaping our returns. So we have a lot of people who spend a lot of time on asset allocation as well. I'm going to talk about a lot of these topics during the course of the presentation. I guess a key thing I wanted to go over, though, before we go into these best ideas is my thought is that you're all operating with some sort of asset allocation plan that makes sense for you given your life stage. So my advice would be to not take this as any sort of signal to upend your well-laid plan. These are mainly some things to think about if you are looking at your portfolio today in what might feel like a pretty fairly valued market, given that we've had a 10-year rally in the U.S. equity market. Some ways to think about maybe doing a few tweaks around the margins of your portfolio. But the suggestion should never be that I'm suggesting that you are completely turning over everything that you have and instead swapping into this group of investments that I'll talk about today. So just a quick review of where we've been over the past 15 years. You've probably seen charts like this before that show various asset class returns. And you probably can't see this in the back of the room, so I'll just quickly describe what you're looking at. You'll see that the blue bars, the blue bands, which represent small and large cap US stocks, well, those have performed really, really well, to the point that they are the number 2 and 3 top performers over the past 15 years. So we've had quite a run in the US equity market. At the top of the heap, though, somewhat surprisingly, because it hasn't felt that great recently, are emerging markets equities, which have performed really well, but have done so in short bursts rather than in a continuous streak in the way that the US market has. But one conclusion that you can draw from looking at this slide, which I admit is kind of a data dump, is that you have been rewarded for risk taking over the past 15 years. And over most longer time frames, that's something you'll see again and again. You'll see the riskier assets rise to the top, and the more conservative assets which have lower volatility profiles, they'll typically be toward the bottom. And in fact, that's what we see here, where we see the bond categories as represented by orange, kind of at the bottom on that far right-hand column over the past 15 years. So risk-taking has certainly been rewarded, whether you've been an equity investor or whether you've been a bond investor. With bonds, you've been rewarded for taking interest rate risk, for venturing out on the interest rate spectrum, because we've seen yields decline, and that's good for bond prices. So you've been rewarded for taking interest rate or duration risk. You've also been rewarded for taking credit risk, because typically when we have periods when the equity market has performed really well, well, junk bonds and lower quality bond types go along for the ride, because they tend to be quite sensitive to what's going on in the economy and what's going on in the equity market cycle. So that's just a quick review of where we've been over the past 15 years. This is a slide that was prepared by some of my colleagues in Morningstar Investment Management. And this is their asset class forecast for the next 10 years, so for the next decade. And this is something that they update each quarter. And you might say, gosh, it's pure folly to try to predict what the market will do. And I guess I would mainly agree with that, except we need to have some sort of assumption to plug in. If we're using some kind of calculator, or we're working with a financial advisor to help us figure out, well, how much can we expect from the market over X time horizon until we begin drawing our money out? And how much of the heavy lifting are we going to have to do ourselves with more savings? And so you need to have some assumption about what the various asset classes will return. I would say anytime anyone is making a one-year forecast or a really short-range forecast, now that is folly, because it's impossible to predict that with any degree of success. But longer term, you can look at current dividend yields on asset classes combined with your expectation of earnings growth, and also adding in your expectation of whether price multiples will rise or contract over the specific holding period. So the takeaway, and I'll describe it to you if you can't see this slide in the back, the takeaway is that our asset allocation folks at Morningstar are not super optimistic about the return prospects for U.S. stocks or bonds over the next decade, which is not to say that if you have a longer time horizon, you shouldn't expect robust returns from them. But over the next decade, you probably want to think about being conservative about what the market will do for you. And that's simply because we have had such a long-running equity market rally. It's only realistic to have realistic expectations once you've enjoyed such strong gains for so long. And bonds have actually been terrific too. Even though they've gotten less attention, bonds have been tremendous performers over the past 30 years, in part because we've had this steady drip-drop downward of declining rates. So a takeaway from this slide is that we should all be sober when thinking about what U.S. stocks and bonds will do for us. You'll see, though, on this slide that they think things are a little more interesting in international markets, both developed markets and emerging markets. So I'll touch on that later and touch on some specific best ideas related to international investing. But for now, we'll focus on U.S. stocks mainly and where our team is or isn't finding opportunities. So before I leave that, we're not alone in being somewhat pessimistic about the prospects for U.S. stocks. So each January, I put together this compendium of what other firms are expecting in terms of asset class returns over the next decade. And so I look to people who I respect. I usually include Vanguard, but I don't think they had anything super up to date for this latest compendium. But you can see that across the board, whether they're forecasting nominal, meaning non-inflation adjusted returns, or real, which means inflation-adjusted returns, you can see that generally the outlooks are similarly sober. Maybe not quite as pessimistic as our team at Morningstar, but directionally similar. Nothing like the tremendous gains that we've all enjoyed from our U.S. equity and bond holdings over the past decade. So that's somewhat sobering. In fact, it got me to use one of my favorite emojis that's always in my tray of texts that I send people. So Given that we are not especially optimistic about the outlook for U.S. equities, another thing that I take a look at, and you can find this graph on our site, it's called our market fair value graph. This looks at what our bottom-up equity analysts are saying about whether the market is cheap or dear based on their bottom-up analysis. So when our analysts cover companies, we ask them to do discounted cash flow analysis to arrive at what they think a company should be worth based on what it's projecting based on what the analyst is projecting in terms of future free cash flows. So if a company is worth, if our analyst thinks the company's worth $80 and it's trading at $100, well, it's overvalued. If it's trading at $60, it's undervalued. So this graph takes all of our price to fair values for all of the companies in our coverage universe and aggregates them. And I like to look at this because I think it's another sort of check on, well, is the market cheap or expensive? And this is based on our bottom-up research. And what you can see is that this is bumped around a little bit. But that right now, and I'll just call your attention to under the dates at the top, today's ratio, I took this screenshot yesterday afternoon, right around fair value, a hair below fair value. So the typical company in our coverage universe is trading about 3% below our estimate of fair value. That doesn't mean that we think stocks are super inexpensive, but nor does it mean that we think they're overly pricey at this point. So the thing I like about this graph is that you can then kind of drill in. There's a left-hand navigation bar that got cut off, but you can drill in and look at various other subsegments of the market. So one I like to look at is what we call wide moat companies, companies with sustainable competitive advantages. And so I just included a few examples of wide moat companies. One would be Google. You know, its name is synonymous with search, so that's a good indication that you've got a moat. You've got some sustainable competitive advantage. Whenever I'm doing a search on the internet, I don't bring up Bing, I bring up Google typically. So just a short list of companies that have moats, and they can arrive at moats in different ways. So Amazon.com is a company that has largely earned a wide moat designation because it has scale. It's simply really large. If you're looking for, I was looking for something to stabilize my patio umbrella. I felt like it was shaking around a little bit in the table. Where else are you going to go for that? Maybe your hardware store, but you might have to go to 2 or 3 to find exactly that gadget in the color that you wanted. Amazon is the place for stuff like that. So Amazon has built a wide moat through scale. Loyalty, customer loyalty and willingness to pay more for your product relative to competitors. Their Harley Davidson, I think, is a good example of that, right? Where the motorcycles are more expensive, but the bikes have consistently traded at a premium relative to other motorcycles. One of my colleagues, I've told this joke oftentimes, but one of my colleagues once said, you really know you have a moat if people are willing to get your your logo tattooed on their bodies. That's a good indication that you've got a moat going on, and Harley Davidson obviously has that. So this is just the universe of wide moat companies. These are generally higher quality companies that have the ability to fend off competitors, even in perhaps a toughening economic environment. So all else equal, we should want to pay a little more for the wide moat companies, but right now they're trading right in line with the broad market, and they're actually the cheapest of any of the moat bands. So they're cheaper than narrow moat companies, and they're also cheaper still than no moat companies. So no moat companies are trading actually above the broad market currently. So this suggests to me that if you're kind of thinking about repositioning your portfolio a little bit, making some tweaks, that you might consider shading things a little more toward the higher quality companies in your portfolio, because we've seen some lower quality companies perform very, very well, and their valuations aren't what they once were. Just a couple of quick illustrations of companies without moats, and that's most of our coverage universe actually. About 2/3 of our coverage universe does not earn any sort of moat. So retail is a classic place where it's very hard to earn a moat. Consumers are price sensitive, especially now with the internet. They'll shop around rather than being brand loyal to any one retailer. Restaurants, also really tough to earn a moat. People are fickle. People want to try the new restaurant, and so they tend not to be super brand loyal to specific restaurants as well. Airlines are another space, just kind of you might have your favorite airline that you like to fly, maybe because you have miles there or whatever the case might be. But most of us aren't super brand loyal when it comes to booking airline flights. We're pretty price sensitive. And if for whatever reason, I'm normally an American flyer, but if for whatever reason the United flight was twice as much or twice as cheap as the American flight, I would probably fly that. So wide moats look a little more cheap than the other types of companies in our coverage universe. When we look at the style box, and this is a slide I pulled from a publication that we put out called the Morningstar Markets Observer. This attempts to look at price to fair value by style box. And the biggest discounts, perhaps somewhat surprisingly, are actually in the small cap space, the small cap value space. And if you have small cap value holdings in your portfolio, you've probably experienced that. You've seen the large and mid cap growth and small cap growth, whether you have equities or mutual funds, you've seen those perform really, really well. We've seen value have a terrible run relative to growth. So there's a bit of a bifurcation when we look at the companies that land in the small and mid cap and large cap value column of our style box. We think that those companies are quite inexpensive relative to the broad market. So that's another takeaway as you kind of think about repositioning your portfolio. You can also look at these price to fair values by sector, and sometimes some really impressive things will jump out from this. You'll see sectors be really overvalued or really undervalued. Looking at this yesterday, I was kind of, nothing too exciting. I suppose if there's one sector where there appears to be pretty big discount to fair value, it would be the energy sector. Our analysts there apparently think that there are some cheap stocks currently. But a point I would make is that you also want to think about the volatility of that sector. And also if we're concerned about moving into some kind of a recessionary environment, and I think that's an open question as to whether we are, I think you do want to probably have some reservations about moving full throttle into the energy sector because it's really sensitive to what's going on, not just in our US economy, but globally. So just some food for thought on the sector front. Another thing I would call your attention to is look at utilities, look at real estate, mainly because when you think about sectors that have performed well recently, those have, in part because they tend to move in sympathy with the interest rate cycle. So when bond yields are coming down, investors look around and say, well, where can I earn a yield that kind of gives me something better than what I'm able to earn in the bond market? And so we've seen real estate and utilities and a lot of the other yield-rich sectors rally because investors are looking at alternatives for fixed income yields, which are pretty low today. So to kind of roll up some of these ideas, I periodically like to run a screen on Morningstar.com, and I've got my email address at the end of the presentation. If it would help anyone, I can send you a PDF of the presentation early next week. So you can send me an email using my email address. But this is just a quick screen that I sometimes run just to see if more companies are making it through or fewer. And as of yesterday afternoon, this was, I believe, 13 companies. So a pretty short list of companies that have 4 or 5 stars, meaning that our equity analysts think that they're trading at a good discount to fair value, that have wide moats, meaning that we think they have sustainable competitive advantages, and have what we call low fair value uncertainty ratings. So in addition to asking our analysts to come up with the fair value of what they think a company should be worth, we also ask them to say how sure they are about that fair value. So if I were to talk to Erin Lash, who has covered the packaged goods companies for us for many years, and she covers P&G and those sorts of companies, well, she would say, yeah, I'm pretty sure that this company should be worth X because the variability in sales of Pampers and Bounty and things that we all need in our households tend not to change that much from quarter to quarter. On the other hand, if I were to go to our energy analysts, and I'm sure this is exactly how it would happen, I would go to them and say, okay, so you think energy stocks are cheap, as we saw on that slide, but how sure are you that that your price target will come through, and all the other factors that you need to get your arms around to make any sort of forecast about what an energy company is worth? How sure are you about that? And it's a good bet because it's such a cyclical sector that our analysts would want to hedge a lot. So he or she would probably have a high uncertainty rating on that, what they think is a low valuation, whereas our analyst on the companies with a higher degree of certainty around earnings and cash flows would be more certain about her forecast. So I look for those three things. 4 or 5 stars, meaning we think they're cheap. Wide moat, meaning we think they're good quality. And low uncertainty rating, meaning that we're somewhat sure about that fair value that is determining the 4 or 5 star rating. So it's a pretty short list. I have to say it's pretty consistent. That this list has been the same for a couple of months now. In fact, I was updating this presentation, which I had done a couple of months ago in Silicon Valley, and the list was very similar to the one I prepared at that time. So you can see a few tobacco makers, and it's obviously a personal decision about whether you'd want to invest in a tobacco maker. I know I have some in my portfolio indirectly, but I probably couldn't see myself going out and buying a tobacco maker straight up. But there are a few tobacco makers here, a few energy companies, a few consumer staples, a few pharma stocks here as well. So just a short list of companies that could be worthy of further research, especially if you're kind of looking at your portfolio and you're an equity investor and you want to make some tweaks and potentially adjust it so that you're setting it up for maybe decent returns ahead. So translating some of those themes into fund ideas. So this is a short list of traditional mutual fund and exchange traded fund ideas. Again, emphasizing those that look for high quality companies, emphasizing funds that look for high quality companies, also emphasizing funds that focus on valuation in some fashion. So Jensen Quality Growth is on the list. It's actually, I think, lands in our large cap growth category, but its managers are quite valuation sensitive. And that applies to all of the funds on the list. I've included a combination of actively managed as well as index products. I know more and more investors are quite reasonably gravitating to index products. At Morningstar, we actually think that you can do well with either type of product. The key with actively managed funds, though, is to look for those with very low costs, because we find that as one of the best predictors of whether a fund will be a good or bad performer relative to its peers. A couple of ideas for those of you who want to take a look at the smaller cap portion of the style box, because we showed that that appeared to be the most attractively valued to us today. So Royce Special Equity is one that I would call out as a fund that we've liked for a long time. I think it reopened in 2016 to new investors. We've seen dramatic outflows from active funds. It's a really good fund that has a lot of sensitivity to what's going on in company balance sheets. So it came through the financial crisis with flying colors, that it tended to perform very, very well. Vanguard Small Cap Value, of course, would just be a pure play on small cap value stocks and obviously very inexpensive. I've included the tickers for both traditional mutual funds and exchange traded funds. I tend to view them as somewhat fungible, especially in Vanguard's lineup, where the ETFs are simply share classes of the traditional index funds. There aren't a lot of reasons to necessarily favor one investment type, the ETF or the index fund, over the other. Though if you're venturing beyond Vanguard and you're holding the fund in a taxable account, you'd probably want to favor the exchange-traded fund. So non-US equities, we saw this slide earlier, and what you can see is that the bar where the forecasts are the most attractive are international developed markets and emerging markets equities, where our team is forecasting much better returns overseas than in the US. And this, oh, sorry, go ahead. Yeah, so I'll just describe what these bars are. So the aqua bars, where they're all, or mostly all in positive territory, that is the expectation of the return, the annualized return from these asset classes over the next decade. And the green bars at the bottom represent the change from the previous quarter. So this is something that we update quarter after quarter and put in this Markets Observer publication. So you can see first half really was I think this is updated through mid-year, so through mid-June or through the end of June. We had a great environment in the first half of the year. So necessarily we took our return expectations down a little bit because of that very strong performance. Yes, question. So the question is, does this include dividends? And yes, this would include dividends. So this is our all-in return assumption for these asset classes. And before we go any further, I won't spend too much time on this slide, but I would just get back into what we look at when making these asset class return forecasts. And frankly, I think this is pretty much how any sane person goes about it. You're looking at starting dividend yield, you're looking at your expectation of earnings growth, and you're looking at your expectation of price earnings multiple expansion or contraction. So, and Jack Bogle, who founded Vanguard Group, used to sometimes shorthand that as speculative return, your expectation of PE and expansion or contraction. So those three things figure into these forecasts for us. So you can see, though, the major takeaway that I wanted to impart from this slide is that international looks more attractive to us than US. And it stands to reason. I know a lot of investors are kind of giving up the faith with their international holdings, but we've seen much better performance from US stocks and much worse performance from foreign stocks, and that means that, at least to our team, that valuations are more attractive overseas today. Yes, question here in front. Yeah, good question. So the question is, what is the, how do we take currency fluctuations into account when making this forecast? So this would be a forecast for US investors, so it would factor in any expectations about the dollar appreciating or declining over this particular 10-year period. And I apologize, I don't know off the top of my head if their expectation is that the dollar will fall relative to foreign stocks, but I know that that is baked into this assumption. That's right. That's right. So this is a slide prepared for U.S. investors. So we're assuming that you are holding the investment in the U.S. and that you will cash it out in U.S. dollars. So it's factoring in the currency fluctuations. So this is a slide, I realize it's terribly hard to read, but this goes region by region and looks at price to fair values within each of these regions. And so a couple of things jump out at me. One is that Europe looks relatively inexpensive, especially when you look at that red bar, which represents the median stock. So it's not the market cap weighted average of foreign stocks, but it's actually the median stock in those markets is quite undervalued. Japan also, or Asia Pacific, I should say, also quite inexpensive, and a few other markets. But these are the main drivers of our expectation that returns could be relatively robust overseas versus in the US. So I mentioned that the valuations are the main factor driving our optimism, our relative optimism, I should say, about the prospects for foreign stocks. There's some, I would say, a divergence of opinion within the investment community about emerging markets. As you can see on this, I'll go back. You can see on this slide that our analysts' expectations for emerging markets relative to developed are actually somewhat worse return expectations. And that gets even worse when you factor in the fact that emerging markets typically bring a lot of volatility to bear. If you have a standalone emerging markets holding in your portfolio, you know this. You get really dramatic swings both up and down. So our analysts aren't particularly sanguine about emerging markets relative to developed, but I would say that there is divergence of opinion on that in the investment community. So a couple of firms who I like a lot, they tend to be somewhat pessimistic but valuation conscious, are pretty optimistic about the prospects for emerging markets equities. So GMO, Grantham, Mayo, Van Otterloo, which is a well-respected asset allocator, is forecasting 4% real, meaning inflation-adjusted returns from emerging markets equities. Research Affiliates, which is Rob Arnott's firm, which also does a lot of asset allocation work, is similarly positive on emerging markets. So I'll just leave you with that, maybe something to research a little bit further. But I think the general takeaway is that really across a range of forecasts and using a variety of different metrics, foreign stocks look cheap relative to US. So how does that translate into specific ideas? Well, we saw on the one slide, we saw some specific individual stock ideas. So some of the companies on that slide were domiciled overseas. So if you're an equity investor, you can take a look at some of those. On this slide, I've just highlighted some foreign stock mutual funds and exchange traded funds that we like. Here again, I've used a combination of both active and index products, generally focusing on those that are gold rated by our analyst team. So on the fund side, we have a medalist system that we use to help designate which funds we really like and which we don't like as much. So the highest rating is gold. Gold, silver, and bronze are all sort of high conviction, highly rated funds. And then neutral and negative are for funds that we don't recommend as highly. I included one emerging markets equity fund on this list, one that I like, which is American Funds New World. It's a little different from your typical emerging markets equity fund in that it holds some bonds. It also holds some companies that are not domiciled in emerging markets, but instead just derive a lot of their business from emerging markets. So it tends to be less volatile than the typical emerging markets equity fund. Certainly if you are interested in a good standalone emerging markets equity fund that's sort of a pure play, you might look at an index fund, or we have other gold rated funds in that space as well. Yes? Yeah, so the question was about trade wars and how we should think about foreign stocks in that context. And so the short answer is no. In terms of our fund recommendations, we don't see our skill set being particularly strong in terms of macroeconomic forecasting. We tend to focus more on sort of bottom-up considerations like the ones we talked about where we're looking at valuations, and tend not to think a lot about what might happen with the trade wars. There might certainly be an impact, but on a valuation basis. And certainly events like that tend to get priced into the market pretty quickly too. So we still believe that emerging markets and foreign stocks in general are relatively attractive. So just want to quickly spend a few moments on bonds, and I think I'm almost out of time here. Just spend a couple of moments on bonds, though. As we've all been reading and hearing and watching on TV, this mini yield curve inversion has definitely benefited some of the longer duration bonds. So where yields have come down, or with the expectation that yields will come down, we've seen very strong performance among long duration bonds. As many of you have heard, the yield curve inversion has historically been a good recessionary indicator. I was speaking to a couple of people this morning, though, and I think there's the general sense that at least the inversion that we had very recently was so short-lived that it's hard to extrapolate a lot from it. I think we'd probably want to see more of that before really taking recessionary fears and running with them. But nonetheless, it's something worth having on your radar as you think about your portfolio, especially as you think about your bond portfolio. But the fact is, declining yields have gotten priced into the bond market pretty quickly to the point that long duration bonds have dramatically outperformed short-term bonds. Another factor to keep your eye on is the yield differential between high quality and lower quality bonds. And typically when investors are feeling good about the economy, the differential narrows. So we'll see investors are willing to take the risk of higher yielding bonds because they expect that the economy will continue to be strong and they expect that the companies will continue to be able to make their coupon payments. So we've seen the yields be pretty low, or the yield differential be pretty low. That's kind of been a persistent pattern with a few exceptions throughout much of this recovery. Just a quick note on the higher yielding bond types. I know that their yields certainly are more attractive than what's available on high quality bonds today. I guess I would just go back to that environment of the late, of 2008, where we saw such a shock in those fixed income types, where even though returns weren't as bad as the stock market, they still were directionally similar. So investors had losses that didn't feel particularly bond-like. So in terms of what should be on your radar, as a bond investor, while I've gone over this a couple of times, long-term bonds especially have performed really, really well. Just remember that you obtain a ton of interest rate sensitivity with them. And one thing I often tell investors is to run through what we call a duration stress test, where you're taking the duration, the interest rate sensitivity. It's a measure that you can find on your fund company's website or on Morningstar. You find that duration, you find a statistic called SEC yield, which is a current snapshot of yield. So you're subtracting that yield from duration, and the amount that you're left over with is roughly the amount that you would expect that product to lose in a one-year period in which interest rates trended up by 1 percentage point. So we actually saw this stress test in action in 2018, where we had a pretty good increase in interest rates in a short period of time. But I guess as a cautionary note against looking at the recent performance of long-term bonds and expecting any sort of repeat performance, well, just bear in mind the interest rate sensitivity that you get with these products. So right now, if you're looking at sort of the highest interest rate sensitivity product you could possibly find, a long-term treasury investment, well, right now you've got a duration of like 17 years. And because yields have come down, you're not getting much of a cushion from your yield. So just a 2% yield currently, that would be a roughly 15% loss. And that's not what most of us are holding bonds for, right? We're holding them to be shock absorbers for our equity portfolios. So just a cautionary note about venturing out on the risk spectrum in search of yield. This is just some of Morningstar's favorite core fixed income types, and I guess that would be my general takeaway regardless of the current market environment, that it's probably best to go broadly diversified, not try to get too cute in terms of timing parts or segments of the duration spectrum. Probably not a great idea to get too focused on any one specific fixed income subsector. I like the idea of having just a broad-ranging intermediate term bond, or maybe a municipal intermediate term bond fund if you are in a taxable account, and then focusing on something similar for your shorter term assets where you expect to have a nearer term spending horizon. I would keep things pretty diversified and pretty vanilla there as well. So I think I'm pretty much out of time. I think I can maybe take one question, and I will project my email address here. If you would like to send me an email and get a copy of the presentation, I'd be happy to send it to you. So any questions?
Yeah,
Yes. So do we have, can you repeat the question for me? So we do, we'll tell you where a company is domiciled. So if you're looking at an individual stock, it'll tell you whether it's headquarters or in the US or overseas. Maybe you can. Okay, so how much of your total portfolio to invest outside the US? Really good and important question. Here I would look to a couple of things. First, I would look to the market capitalization of the globe as kind of a starting point. So right now, I believe the US market is roughly 55% of the total equity market capitalization, and foreign stocks are the other 45%. So that's maybe a starting point. And I would say that a truly globally diversified mix along those lines might make sense for very young investors. But the key thing to keep in mind as you get closer to retirement is that currency risk came up a couple of times. And if you own some sort of a foreign stock fund or a foreign stock that is denominated in foreign currencies, you're picking up on some currency risks, and you will be spending, if you need to pull money out of that account, you're going to be spending your money in the US, right? Well, unless you travel a lot. And so I would say that you'd probably want to back off of the foreign currency exposure a little bit as you get closer to drawdown mode, because you will be spending from that portfolio in US dollars. But you could also buy a hedged international product as well. So I think I'm going to have to leave it there. They're giving me the hook. But thank you all for being here. I appreciate it.